Hi, I'm Peter Rose, founder of Longwood Currency Trading. Currency entry theory and indicators is the topic that I want to cover today with you a little bit. As a kind of a, I always like to give analogies. I'm out here, by the way, today, a couple of days after my video on opportunity, and it was cold and it had been raining, and today it's not raining, the sun is out, and it's 70 degrees, it's very warm, and so I was coming out to check on some stuff. One of those is our famous snow depth chair. You've probably seen that if you watched the videos over the years from me. This chair, the snow, this is 36 inches up from the ground, so we've seen this past winter the snow being up around into here, and even with the deck, so it'll be a lot of snow. Well, the poor snow depth chair, as you can see, the structure is having a hard time. That structure that you see broken there, that forms a purpose. It holds the chair together. And when that breaks, you fix it and it fixes the chair. Is there the same type of correlation between that and indicators and entry theory in the currency market? My position is there is not. Now, I've done a lot of videos in the past where I've talked about indicators, and the indicators don't work, and they're not useful at all. The caveat to that is twofold. Number one, they're not useful in currencies, and number two, they're definitely not useful in entry. You might be able to use some of those indicators if you're doing if you're in a position, a longer term position trade, or if you're swing trading off tops and bottoms. You might be able to get some indication through moving averages, but I wouldn't use anything else. A lot of people talk highly about Bollinger Bands. What's a Bollinger Band? It's a moving average with the two boundary condition lines being standard deviations from that mean average line. So you can adjust the moving average you're using, and you can adjust the standard deviation between those supporting lines. Where's my dog? Hey, Bo, you got to come on up here. A mailman will be here soon, and I don't need you going after him. Come on, come on, come on. I just got back from my granddaughter's lacrosse game, and the poor Bo dog, he doesn't get to come because he doesn't behave himself. So I thought I'd bring him out here to while I do this video. And the use of an indicator is supposed to indicate something, but every indicator references what happened in the past. If you're interested in what happened in the past, and you should be, whether you're doing stocks or whether you're doing currencies, then a moving average will give you some idea of the well, the trend bias. It'll give you some indication of where order flow is by where those moving averages tend to change. You look at past candle size based on the ATR. Has that changed? Is there a differential between the ATR on the current chart versus the chart above that? I mean, you get all that stuff. That's all past information. Are those really indicators? I really don't think that they are. I don't think moving averages are indicators. They're moving averages. A Bollinger Band, which tries to use those moving averages in a certain way, is an indicator. I don't know whether you can tell the difference in that or not, but that's the way that I see it. So if all these indicators, Bollinger Bands, RSI, stochastics, bat frickin' patterns, you know, What does that have to do with what's going on right now? If you have an 18-period moving average and you're calculating that next moving average point, that moving average point doesn't really exist at the 18th line down there. That moving average point belongs 8 candles back, half of the 18, 8.5, 9 candles back, 9 candles back. Because the moving average is a moving average over all of those points, and so that end point needs to be moved back 9 candles. Most people don't know that. They ignore that because they don't understand what a moving average is. And so you're saying, well, when the fast MA crosses the long MA, that's a signal that you should buy if the fast crosses upward over the long. Really? You have an 8-period matching against say a 21 period. What possible correlation could that have with the current price action? And how can that be used as an entry indicator? You might say in a long trending price that the movement of the moving averages creates a trend bias, a direction of trend bias. And based on the periodicity of those moving averages, whether you're looking at the 8 or you're looking at the 200, they all have periodicities. It's just that the amplitude is muted the longer the moving average, right? You have a flatter line for a 200 moving average or a 50 moving average than you do for an 8-period moving average. So those of you who are still using indicators, or you're listening to these people on these videos saying, oh, I did my entry theory based on this, blah, blah, blah. No. They are confused. They may have a sense for the trading, but it's not based on a friggin' Bollinger Band, an RSI, a stochastic moving average crossover system, call it a Golden Cross, or a London Open, or any of those indicators. It's based on their ability to say, man, this price really has the juice necessary to do this. And so I'm going to put my bet on the line because I'm a 60-40 trader, a 70-30 trader, and so 60% of the time, 70% of the time, I'm going to be right. And when I'm right, I make more pips than I do when I'm wrong. Because why? Because it just works out that way, or they actually do something calculatable. I always talk about the win-to-loss ratio. And if you understand what that ratio is, it actually decomposes into 7 parameters. And there's only one of them that you have any control over. The other 6, it's jump ball. So the win-to-loss ratio is not something you create by your trading. It's something that's manifested as a metric from your trading. So you can say, well, how can I use win-to-loss ratio in my entry theory to determine whether I should take the trade or not? Because I don't know, because I'm just getting started, and it's going to take you 50 to at least maybe 100 trades of actually doing good trading as opposed to doing stupid shit. And so how do you differentiate between doing stupid shit and doing good trading so that you have a large enough sample size of data in order to say, oh, I'm a 60-40 trader? You see the problem there. So you can't look at 10 trades and go, oh, I just won 6 of those and I lost 4 of them, I'm a 60-40 trader. Well, no, because if you run a computer simulation and you just do that, run those calculations 10 times, and then you run them again another 10 times, and again another 10 times, you're going to get totally different win-to-loss ratios. If you run it 1,000 times, and then you run it another 1,000 times, you'll get pretty much the same win-to-loss ratio within maybe one tick. Instead of a 60-40, you may get 59-41. And that's all. You could be a, and I can't do the math in my head because I'm not capable of doing that, but you could be a 22.5 to, excuse me, an 64.53 to 1 win against a 58.375 loser. Yeah, whatever those numbers come out to be. We just arbitrarily chop off the insignificant digits, in physics we'd call them insignificant digits, and say you're a 60-40 trader. And you need that information in order to make entry decisions. So what do you use to make entry-level decisions? What are you being taught? Well, the only thing you can be taught from what I see out there, people doing, is telling you that use the golden cross. When the fast moving average crosses up above the slow moving average, that's a buy signal, and when you reverse that, it's a sell signal. When the RSI reads this, then you do that. When you've got a Bollinger Band where the price bumps off of the top standard deviation line, then that's a sell. That's all they can do, because how do you express, I'm a swimmer and I just won the medal. I won the championship. Somebody says, well, how did you win that? Well, I swim. Oh, well, what do you do when you swim to make you win? I move my arms faster. Well, I can move my arms pretty fast. Well, I cup them in a certain way, and I do this and I do that. Well, you get to a certain point where the person who's doing the swimming, none of that means anything. They just swim. And the ability to just swim and win that medal is the same thing as trading and gaining experience to be able to look at current price action and have a sense for what it's going to do. You're driving your car. You have a sense for what everybody else out there is going to do. Unless you get some nutcase. There was just a video online about some stupid kid driving 120 miles an hour in his car, flipped over the median line and crashed into a cop car that had stopped to give a ticket to somebody else. The cop was injured. The guy's going 120 miles an hour. So you're always going to run into those anomalies that are going to happen. If you haven't traded long, you won't recognize those anomalies and you'll get caught. Well, there's ways that you can mitigate that. There's ways that you can deal with it. But it's not by using indicators, particularly during your entry analysis. Indicators have less importance in all of the currency trading because they make no sense because of the characteristics of the currency market. You can use those indicators in the stock market because the stock market is a whole different animal. And there's reasons why I say that. I go over this and cover it pretty extensively in the foundations course that I teach. I have 4 modules that I teach: foundations, principles, process-oriented trading, and then advanced solutions. Those are the 4 modules of my course that I work with someone over about a 6-month period of time. Don't ask me if it's $500, it's not. Don't ask me if it's $1,000, it's not. It's significantly more than that, and I'm not in the business of selling courses. Don't call me and ask me to take a course unless you're serious about making job replacement income and you've got some money to spend on education and you're going to be willing to do the work. Remember, I've taught martial arts. I've taught karate for 55 years. I don't tolerate slackers or unmotivated people. I am not dragging anybody across the finish line. You got to really want it. So what I'm trying to do with these videos is to help you so that you don't have to take my course, and to dispel a lot of the myths that are out there that have been expressed so long by so many people, mostly people coming from the stock markets and other markets into the currency market and thinking that the markets are similar and you can use the same tools to solve that as you would a stock market, using indicators and the tools that they use there, and volume and seasonal adjusted stuff in commodities and all that stuff, and you're trying to map that into currencies. It doesn't work, and there's a reason for that, and it's the same reason that on a short-term trading basis, even a swing basis, you don't really give a shit what the 200 period moving average is doing, do you? Because it's a flat line. You're going to be more interested in what's the 21 doing, and maybe down to the 8. If you're a day trader like I am, it doesn't do you any good to go over those lower moving averages, because it's not reflecting anything. If I'm looking at moving averages, I'll look at the 50. It's a different number, but most people call it 50, so that's fine. Simply as a trend indicator over the longer term on that currency pair. And sometimes I'll take a maybe a 20 period moving average off of the 1 hour chart and bring that down onto maybe the 15 or the 5 minute, as to what the equivalent line would be there in 5 minute increments or 15 minute increments, and it acts the same way. Probably would be maybe the same as a 200 period. I mean, there's a lot of things that you can do to look at this stuff in order to determine trend. And I think there's a lot of educators out there that get so wrapped around the axle at trying to use multi-time frame analysis and trend bias and all this other kind of stuff. Why? Open the chart up and look at what the daily 20 period moving average is doing, and then drop down onto the 5 and make your trades. What difference does it make if you're counter trending on the 5 minute to what's going on the daily? What difference does it make? The daily chart on the major pairs is the ATR is anywhere from 80 to 120 pips. I mean, why would you care what the daily daily 20 period moving average is? Why would you care? I mean, are you going to be affected by that as a day trader? Maybe in a long-term bias situation, you look at the daily chart and you go, geez, this price has been going up for 4 days now. Well, yeah, but I'm trading on the 5 minute chart. What difference does it make if it's been going up for 4 days? Because it's going to have retractions. The retractions could be 60 pips. Now, I can make a lot of money on 60 pips. If you can capture a 30 pip flip on a day trade, man, that's great. Do you understand what a 30 pip run on a 10 lot is at $100 a pip? That's a lot. It's a lot. So to get lost in the weeds of your education and confusing yourself and what potentially is supposed to be a valid trading plan based on a solid framework of rules, how are you going to be able to do that by doing what everybody else is doing, following along the herd, and using tools that aren't applicable in the currency market, particularly using the indicators during your entry? And look, the only time you should be losing any money is at entry. Once you get beyond the entry stage and into position management, and I clearly define in my coursework when I'm working with someone where that dividing line is. After you pass that dividing line, there's no loss beyond that. There's no excuse for a loss beyond that. But we all get caught on it because we don't stop out when we should, or we let the thing run and we stage in our lots the incorrect way, and all of a sudden price pukes on us and drops 20 pips in 3 seconds, and you've hit 2 of your last stage points, and they were both big, and they completely wipe out the entire trade. And although you're 30 pips into the trade, you've now lost, you're into negative territory with the trade as a whole, because you didn't understand what you were doing. You didn't understand the tools that you're supposed to be using during entry as opposed to the tools that you're going to be using during position management. Because remember, I teach what I call the life cycle of a currency position, and I get that directly out of my 33-year career as a software engineer, where you had a software development life cycle. You solve a software problem, the problem of the application, by breaking it up into pieces, solving each individual piece, having the communication between this piece and that piece, tying all the pieces together into a logical order, and boom, you've solved the problem. And it's manageable, it makes sense, and it's what we call extensible. And so the software development life cycle is, I've used that directly and mapped it down onto the currency market. And you've got entry analysis, position management, and exit methodology. And each one of those areas is a different area of concern. It has its own problems to solve, and I've limited each one to, at most, 3 problems within the problem of that phase. And then each one of those problems has a, what do I need to do, how do I need to do it, and when do I need to do it? Now, you ask me how anybody is being successful in their trading if they don't have their thoughts organized as to what they should be doing. Particularly in your entry phase, you cannot abdicate your responsibility as a trader onto a freaking Bollinger Band. You have to understand how to trade. Now, either you got to figure it out yourself by losing a ton of money, or you got to find somebody to help you out. And it isn't something you can answer in a comment or even answer in emails. I mean, if you know what you're doing, you got a basic idea of the problem that you're experiencing, I can help you out. Maybe not in a comment, but most of the folks that communicate with me do so through email. I've been communicating with some folks for years. They haven't taken any courses from me. I help them out in the emails because I'm answering specific questions that they have problems with. I don't have a problem with that. But when you get to the stage where you need mentoring and guidance, and you want to put all this stuff together into a cohesive plan, because you want to replace your job income, you don't just want to make $3,000 a year to pay your frickin' light bill, but you're trying to make some serious money, you need a serious plan. That's where I come into play with mentoring and consulting and courses and the rest of the stuff. And that's why I don't have any students right now, and I haven't had a student in a long time, because people don't want to pay the money. They don't believe me when I tell them that, oh, I can do it myself, or this guy over here with his hat on backwards and driving his Lambo for $500, I can buy his course. Oh, great, go ahead and do that. See how that works out for you and let me know. I have to keep the camera there because I'm walking into the sun and it's hot, so I think I'm going to go in. That was a long discussion, and it's important for you to understand that there is no correlation between indicators and entry analysis in the currency market. And in fact, I go to that next step and say that there is no utilization of indicators even when you're in your position management stage, whether that position management is a short-term day trade or whether that's spanning a few months. The only tool that you need, not indicator, but the only tool that will help you out on both the day trading, even the scalping to a certain degree, but particularly on the day trading, and mappable up and useful on the long-term trading process that you may undergo, is moving averages. And remember, everything else, every other indicator or anything else anybody's ever going to come up with is all based on something that happened in the past. And it's supposedly predicting something. what it's all based on in the past, anytime you look at past data, you are getting an average of that data to express some value. So you don't need a Bollinger Band, you don't need anything. All you need to do is look at the chart. But you have to know what you're looking for, and it isn't indicators. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.